Good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. Have an exciting set of topics for you this morning. First of all, I'm going to talk I bonds. What are those? Yeah, those are the inflation protection bonds the Treasury puts out. They just released new ones this morning. Let's talk about it. Are they a good idea still or not? So I'll run you through that. Then, of course, it's earnings season. So Mike is going to cover, kind of like where's the market right now, a little bit of history. How are a couple of big names had earnings? We've got McDonald's, Walmart. How are they doing? And then, of course, the big daddies, if you will, or big mamas, whatever you prefer, are we got one later today and have one Thursday. Mike will walk you through all of that. But this is a financial education presentation. You have to do your own due diligence for acting upon anything you hear in this presentation. Full disclaimer information is available at ankerstarwealth.com. The opinions expressed are Mike and mine alone. Let's start off with I bonds. Do you remember these when they ran up big time? The highest it ever got, and I did a specific show on this. This was, PM around here, which is pre-Mike. When I was running shows on I bonds, late 2022, these things got to 9.62%. It's like, hey, if you're going to take 9.62%, you take it. All day is what you do. So these things adjust for inflation. You can kind of see the topic here: inflation protected and nearly risk-free asset. So similar to CDs, right? Nearly risk-free. You can't say completely risk-free. But yeah, the latest one, it's now kind of dropped to 4.28. So, it used to be a great idea when inflation was raging higher. You can only put in $10,000 per person per year, so there's some limitations. You can't take the big six-figure swing at it like you can with the CD. When it's 9.62, good. Now at 4.28. When yesterday I bought a JP Morgan bond at 5.45% out to 15 months. That's still pretty epic. I mean, really, you can't complain about that. So I think right now CDs are a better option. I think CDs will continue to be a good option until rates are starting to be cut, whenever that is. It does float with the market a little bit, but it'll stay above 5% until the Fed cuts rates, if you will. And I don't think that's anytime soon, as you know. We'll see, though. It could change at any point in time. But yeah, so for right now, one of the bigger issues with these is you kind of can forget you have them, because if you do have a significant amount of wealth, 7 figures and above, having 10K chunks laying around somewhere, you kind of like, oh, I forgot I even had these things. And if you leave those around, then of course they reset down, so you're not making as much money. So if you hear this morning, you're like, oh yeah, I did buy one of those in 2022. My recommendation, you have to look at your own situation, is you can do better in a CD right now. So consider going into treasurydirect.gov. It's one thing if you held it in Schwab, you'd be able to see it like you can through your CDs with us, but you can't see it. You kind of forget about it, and now it's adjusted downward. So I think you're better off somewhere else with your fixed income type money. But let's talk about earnings. I'll bring this down, hand it off to Mike, who's going to talk about where we are in the market and how earnings are affecting it.
All right. Today, the market is relatively flat, just down 0.33%. And while that may sound like a lot, or you're seeing red numbers, the graph I'm showing is a 6-month graph of the S&P 500. And that'll give you an idea that, it's just kind of gradually rising. Obviously, there's some dips. There was a dip the past couple weeks. But even when you back this out to a year, you can see dips there as well, and just a gradual increase. So, what's causing it today? What's in the news? So one thing that's in the news is Walmart is down 1.73%. So let me bring that up. I could just show you, over a 1-year graph, Walmart generally up, tracks very closely with the S&P 500. And I always think of Walmart, and I'm going to cover McDonald's next, as just what the overall consumer is doing. I think a large part of this nation shops at Walmart, at McDonald's. These are common things. Walmart's down 1.73%. What is in the news for them? They have decided to close their health centers and virtual care services. And as I thought about this, I thought, why do I shop at Walmart? And yes, I do shop at Walmart, and I really prefer their grocery pickup. That's what I like. Inexpensive prices, grocery pickup, that's what I like. things that don't necessarily apply to health centers and virtual care. I think of Walmart as getting things inexpensive. When I think of my healthcare, that's not always my first consideration. So it doesn't surprise me that they got out of this business. Healthcare, very competitive and ultimately decided a lot by the government reimbursement. So we saw health insurers get crushed about a month ago. Walmart decides to get out of this. As I thought about this as well, Apple got out of the iCar, out of the electric car business, and it's just overall starting to see some companies focus on the basics or focus on using AI to do better business. So Walmart focusing on the basics. That's good news. The other one is, that I wanted to cover, and I know Steve is, make sure that we test out all our stocks and use their products. So if you can see in the camera here, made my trip to McDonald's this morning because their earnings came out and they had an earnings miss as consumers tighten their wallets. So you can even see that. Well, I guess you can't see. I only spent $2 on my biscuit because I got it on sale. And I will say McDonald's is one of the better apps for any kind of fast food. Like their app, give that a thumbs up. Good use of their business model. The earnings missed, and I'll scroll down here and you can see, listen to this. Same store estimates were down. People may think twice before getting that Big Mac. And just overall year over year growth 1.9%. When you consider the GDP at 1.6, it's basically kind of break even. Just overall. So what did the stock do? Initially, the stock was down. If I bring up the 1-day chart, I think we'll be able to see it. The stock was down. Put on news that I went to McDonald's after the bell, the stock is shot up into the positive territory, up 0.34%. So even though they did have a miss, hey, we're seeing the stock come up. So I guess that's good news. We don't have either one of these heavily in our models, although we do have, consumer products. And I know that Walmart and McDonald's are a big part of consumer products. So just to look at that. As far as what Steve said, some big earnings that are coming out that do affect us quite a bit since we are very heavy tech. Amazon earnings after the bell today. Apple after the bell on Thursday. I think it's after the bell, maybe before, but it's on Thursday. So we will definitely be keeping a close eye on those. And with that, I guess I did see Eli Lilly up well on their weight loss drug. So after I ate my McDonald's, maybe I'll pick up some Eli Lilly products.
All right. Thanks, Mike, for covering all that. And if you remember, if you have good memories, Mike did work at McDonald's at some point in time early in his career. But Mike, I do appreciate you moving the markets this morning. Maybe if you could go buy something from Apple. And maybe load up on some Bitcoin while you're at it, please. There you go. All right, everybody. Thanks much. We will be keep your fingers crossed for hitting some green today, and we'll be back with you tomorrow. You guys have a good one.